Gift cards have become quite popular for many retailers, so let's take a look at the accounting for them. Now we know a gift card is a certificate allowing the holder to receive goods or services of a specified value. Sometimes there is a redeemable the date by, sometimes there's not. One of the things we have to keep track of is something called breakage, and that is when the gift card is not fully redeemed. The accounting for the initial sale and redemption are fairly straightforward. Let's look at an example and we'll learn about it as we go. We got Roll's department stores. They show the cash coming in for gift cards of $120,000. The gift cards were partially redeemed in the second year, and so we see the unearned revenue gift cards is reduced by $30,000 and sales revenue is being shown for $30,000. Along with those sales, we're going to show the cost of goods sold related to them, and so that is shown as the second entry. The breakage is when something's not going to be redeemed. There's two methods. We can use the proportional method or the remote method. The remote method is easier, so let's cover that one first. The company recognizes revenue from gift card breakage and removes the liability when the probability of redemption becomes remote. Remember that definition of what a liability is, a probable future sacrifice of resources. So the probability of redemption has become remote. Then we can remove the gift card liability and we're going to show it as revenue. Under the proportional method, things are a little different. Breakage is recognized ratably as the actual card redemptions occur. So let's take a look at this with an example. We got Elliott Electronics and $400,000 in gift sales in the first year. Breakage is estimated at 15%, so this is something they've figured out over time, and they used the proportional method. They redeemed $180,000 in gift cards in the first year. So we're looking at multiple years here, and what we're going to do is we're going to find the amount of breakage in year one that's proportional to the amount redeemed. Okay, it's a little tricky, but once you got it, you got it. Okay, so first we show the gift cards being purchased and the cash is coming in and the liability is being shown for $400,000. During this year one, we had unearned revenue of $180, sales revenue $180. We show the cost of goods sold related to those sales. Now we get to our last part. We estimated the breakage was going to be about 15%. So that total amount of breakage is $60,000. So what percent was redeemed? The redemption part was $180,000. The denominator, though, is $400,000 minus the 60. We never expected the full 400. So $400,000 minus 60, 340. So the total amount that was redeemed was 53% of what we expected. 180 divided by 340. So therefore, we're going to recognize 53% of the breakage revenue in year one. We multiply the 53% times the total estimated breakage, which is $60,000, and we go ahead and show the $31,800. That remaining part of breakage is going to be shown ratably over the year.